In November 2022, one of the world's largest cryptocurrency exchanges imploded in less than a week. It was a name trusted by elite venture capital firms, endorsed by A-list celebrities, and backed by some of the biggest institutional investors on the planet. And then, in a blink, billions of dollars in customer funds vanished into thin air. This is the story of a catastrophic governance collapse played out on a global scale. He cultivated a specific image, data-driven, risk-aware. By 2021, it had secured a multi-billion-dollar valuation. We're talking about giants like Sequoia Capital, SoftBank, and Tiger Global. Everyone wanted a piece of the action. But behind this incredible story of rapid growth, deep structural weaknesses were hidden in plain sight. It was building a house of cards on a shaky foundation. Publicly, FTX projected an image of sophistication and control. Privately, the reality was starkly different. The company's governance was astonishingly thin. There was no traditional board of directors providing oversight. The crucial separation between customer funds and the high-risk trading activities of Alameda simply wasn't there. The risk management systems, which should have been institutional grade to handle billions of dollars, where basic principles of corporate governance were seemingly ignored. So, how did it all fall apart so quickly? The core of the problem was this. Customer deposits made to the FTX exchange were reportedly being used to prop up Alameda's risky trading bets. The company's financial records were so opaque that this massive leverage was completely hidden from the public and even from most investors. Then, in early November 2022, the first crack appeared. A leaked balance sheet raised. A rival exchange publicly announced it would be selling its entire holdings of FTT, FTX's own crypto token. A bank run began, but in the digital age. Customers rushed to withdraw their funds. Within 72 hours, billions of dollars were requested. But FTX didn't have the money. The liquid assets were unfair to meet the demand because they had been entangled with Alameda's losses. Let's be clear. This was not just a market crash or bad luck. This was a complete and total governance failure from top to bottom. The list of failures is long. Internal controls were either inadequate or completely ignored. What about the sophisticated institutional investors? They were sold on the story, the brand reputation, and the charisma of the founder. They substituted trust for verification. In the world of high finance, that's a fatal mistake. They bought the hype, but they forgot to check the plumbing. The fallout was immediate and devastating. A complete failure of corporate controls. Billions in customer funds were frozen, locked away in the bankruptcy proceedings with little hope of full recovery. Regulators worldwide who were already circling intensified their scrutiny. When you zoom out, it starts with rapid, dizzying valuation growth. This is usually led by a charismatic figure who seems to have all the answers. But beneath the surface, there's limited oversight and incredibly opaque financial structures. The cutting-edge modern technology of crypto didn't eliminate these old financial risks. In fact, it amplified them, allowing the failure to happen at an unprecedented speed and scale. The structure failed, not because the concept of crypto failed. It was a powerful and painful reminder that without strong governance, scale doesn't create strength. It creates fragility. And in the world of finance, fragility always, eventually, gets exposed. Thanks for watching. If you found this breakdown valuable, please like and subscribe for more deep dives.